All right, good afternoon, folks. About 15 minutes till the Playboy PLBY group earnings call will start. I'll share, well, first things first, let me go ahead and get a disclaimer out of the way before we start and see how much time we have before the call starts. JP, you're good to play the audio of the call in 15? You're on mute, buddy. Okay, while he figures out his speaker, let me just ensure that everyone is well aware that Wook Capital Management Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results, and all investment decisions of an individual remain the specific responsibility of that individual. So, with that mouthful out of the way, another very disappointing quarter out of Playboy, and unfortunately, no change at the top. No falling on the sword, no ownership from the CEO, nothing. We got some comments from the CEO in the press release. We'll see what the CEO has to say during the prepared remarks and during the Q&A today. The company in the press release, which I pinned both the press release and the updated investor presentation to the spaces here. If you haven't yet reviewed them, it was a very disappointing quarter from both revenue and EBITDA perspective. They missed by about 10%, give or take, on revenues. EBITDA was a loss. I don't even know what the estimate was offhand. It was ugly all around. So the headline is that they've announced a strategic restructuring, and they claim that they've eliminated 15 million in ongoing costs, and that they're simplifying the core business around Playboy and Honey Birdette. Unfortunately, it's just further evidence of Ben Cohn's lack of capability. They are effectively going 180 degrees from what he had embarked on their strategy of becoming a direct-to-consumer with the Playboy brand and business. They are now pivoting away from one of their many pivots, pivoting away from direct-to-consumer for the Playboy brand, and they will focus on a capital light model for Playboy. Not sure what that means for Honey Birdette. They talk about opening up to 15 stores through 2024 in the US. They shared some data in the deck. If you were to go to page 21 of the deck, they talk about the higher customer lifetime value, order value, and profitability that they're seeing in the United States stores for Honey Birdette. So that's great and all, but they paid over $300 million for the business. What they paid for Honey Birdette is now more than the entire enterprise value of the company. So again, the market is still pricing in ongoing value destruction by Playboy management, unsurprisingly, given their track record has been one of value destruction since inception, effectively. But again, got a little bit of incremental data on Honey Birdette. I mean, like them or not, that asset obviously has value. It's whether they dispose of it later this year or not, because quite truthfully, they're leaning all in on the creator platform, which I think is a zero. I think it's been a zero. I think it's always been a zero. Unfortunately, management is not bearing the responsibility of its failures. The chairman has not fired the CEO, regrettably. And unfortunately, it looks like the CEO is just being allowed to continue milking the company. But as I've kind of noted previously, I still think that if there's a liquidation, the assets are worth more than the implied enterprise is being priced at today, although it remains to be seen for how long that can continue with ongoing losses. obviously, there's a lot of noise in the financial statements, given they completed the rights offering after the quarter ended. So, uh, you know, you can kind of try to do a little pro forma of your own if you want. We're going to get the first quarter results really in maybe just like 6 or 7 weeks here. So um, those don't look good from the e-commerce data that crowdsourcing has effectively allowed us to see. Both Playboy.com, US e-commerce, and Honeybird e-commerce are disappointing, to say the least, for first quarter to date, 2023. So, it'll be interesting again to see what management has to say in 10 minutes here. JP, you've got the audio ready to go, because I can't do audio through my end. I'm going to just ping you on the side. You're on mute still. Hey, JP. Okay. All right. We don't need that yet, but I just wanted to make sure you had it queued up. Um, so just a kind of plan of attack here. In 10 minutes, obviously the call should start up. We're going to play the call through the audio here. I'll kind of capture notes from whatever incremental information Ben, whatever hopium he tries to sell to the market, and then we can have a discussion after the call wraps. Hopefully it doesn't go the full hour. I kind of doubt it will. There aren't that many analysts interested in covering this company anymore. So I expect we'll get maybe 3 or 4 analyst questions, and hopefully his prepared remarks aren't too long. It was a pretty brief statement in the press release. So after that, though, anybody who wants to come up and chime in is absolutely welcome to do so. I've been calling for Ben Cohen's resignation now for more than 6 months. It's long overdue. If any other investors are interested in getting a letter to the chairman out in public, would certainly be something that we can consider going forward in the near term. So I've spoken to other investors, large investors who have meaningfully sized positions, and I think that the sentiment is pretty consistent around that. Regrettably, though, there's really nothing that can be done forcibly. Suhail Rizvi retains 30-ish% ownership. Given the structure of his investor rights agreement, there's really nothing that can be done without his consent. I mentioned, I think last night briefly in our open mic conversation, that I've spoken to a few different investors who have had conversations. So this is kind of through the grapevine, hearing conversations with Rizvi. So, look, I've still never personally spoken to him. These other investors generally have decent things to say about him. I don't understand why there's no action taken, but the sense I get is that Cohen is on borrowed time, and if the creator platform is unsuccessful, that we'll see a resolution to this predicament that everyone finds themselves in who's been an investor here. So not that there's any certainty with that. Clearly, if financial markets go into crisis mode, asset sales could be forced, but the rights offering and the debt paydown does waive their cash maintenance requirements and their covenant requirements through to June 2024. So between now and then, they will try this creator platform, it seems. They noted in the release that I don't know what this means. They noted, quote, significant growth potential through our creator platform, which is growing at 9% week over week. I don't know what that means. Is that views? Is that clicks? Is that revenues? What is that? So I expect we'll hear some more detail from management on the creator platform that they've quite literally been all in on for some time now, sadly. Would love to know why they remain so dead set on burning capital on this initiative. But we will wait 5 minutes from now. We should hear some more detail. So sadly, though, no resignation today, no firing today. It looks like Cohn is still the CEO, and don't see anything to indicate he won't be in the immediate future. I'm trying to think of anything else that caught my eye from the deck or the press release. I noticed that the company is citing data in its. Let me get to the correct page here. They are citing on page. Well, for one, the China JV that was put out a month or so back. There is on page 10 of the presentation a few comments about it. It's simply a reiteration that they are partnering with the Fung Group. It says a new entity allows PLBY to strengthen go-to-market efforts across e-commerce, retail, product design, and IP protection by leveraging the Fung Group as a best-in-class partner. However, they said nothing about this in the press release. Today, the press release from a month or so back noted that they expected that to be consummated by the end of the first quarter. So it's unclear at this point in time if that is anything, if it's just more puffery from Cohn. Clearly, he wouldn't put it out if there was nothing to it. But until we get more details, I have no idea how to value it. It could, in fact, be value destructive, like everything he's done with the company, sadly. So it's hard to have any insight onto the JV unless they share more on the call today. I noted, or not noted, on page 7, the company shared some statistics, which I thought was very interesting, that they actually are lifting statistics from the Builders Union consumer survey that was done in December or November of 2021. So in the source, they say, quote, primary Gen Z consumer research. Interestingly, it's research done by a former investor who is now fully sold out of the business that they are citing in their statistics, that 90% global awareness of PLBY amongst Gen Z, 60% view PLBY as a different brand today than in its past, which again, in isolation, those are great things, right? For 9 out of 10 Gen Z consumers, I personally know that the survey covered the UK, US, and China. They don't call that out in their footnote there, but given I know the survey and know all of what went into it, I can point that out. But again, management didn't conduct this survey themselves. Management doesn't do much of anything, sadly, other than burn shareholder capital. But again, if the asset were sold, I still tend to think that the proceeds received would yield a pretty meaningful return for shareholders from current valuations, which doesn't necessarily help anyone who, like me, has a cost basis in the double digits, because I do not see the stock ever returning to those levels personally, barring some unforeseen success of this creator platform, which again, maybe we will be astonished and hear some real details and real data points justifying why management continues to spend all of its time and shareholder money on the initiative. But all we have is a 9% week over week growing at, whatever that means. So yeah, in 2 minutes, we'll let the call start playing. Obviously, I spit out some data, and I'm happy to spit out some more data once we get to the discussion point. Anyone who wants to be a speaker, you're welcome just to request, and we will bring you up. But bear in mind, for the next 30, 45, however long the call goes, we're just going to be playing the audio from the call once it kicks off here. So if you want to rejoin at that point or listen through the call if you're interested, please stick with us, and then we'll get to the discussion and reaction to what management has to say. So I'm going to pause, and JP, if you want to, I guess, put our lovely elevator music on in the background. Thanks, bud. Fittingly, they're late to their own earnings call, but we'll keep the lovely elevator music playing, assuming that they're going to show up.
Greetings
Fucking
and welcome
finally.
to PLBY Group's fourth quarter and full year 2022 earnings conference call and webcast. At this time, all participants are in listen-only mode. A question and answer session will follow the formal presentation. If anyone should require operator assistance during the conference, please press *0 on your telephone keypad. As a reminder, this conference is being recorded. It is now my pleasure to introduce your host, Ashley DeSimone with ICR. Thank you. You may begin.
Good afternoon, everyone, and welcome to PLBY Group's fourth quarter and full year 2022 earnings conference call. I'm Ashley DeSimone from ICR. Hosting today's call are Ben Cohn, Chief Executive Officer, and Lance Barton, Chief Financial Officer. After our prepared remarks, we will open the call up for questions, when we will also be joined by Ashley Kechter, President of Global Consumer Products. The information discussed today is qualified in its entirety by the Form 8-K that has been filed today by PLBY Group, which may be accessed on the SEC's website and PLBY Group's website. Today's call is also being webcast, and a replay will be posted to PLBY's investor relations site.
The 10-K just came
Please
out,
note
by the
that
way,
statements
folks.
made during this call, including financial projections or other statements that are not historical in nature, may constitute forward-looking statements. Such statements are made on the basis of PLBY's views and assumptions regarding future events and business performance at the time they're made, and we do not undertake any obligation to update these statements. Forward-looking statements are subject to risks, which could cause PLBY's actual results to differ from its historical results and forecasts, including those risks set forth in PLBY's filings with the SEC, and you should refer to and carefully consider those for more information. The cautionary statement applies to all forward-looking statements made during this call. Do not place undue reliance on any forward-looking statements. During this call, PLBY will be referring to non-GAAP financial measures. These non-GAAP measures are not prepared in accordance with generally accepted accounting principles. A reconciliation of the non-GAAP financial measures to the most directly comparable GAAP measures is available in the earnings release PLBY filed with its Form 8-K today. I will now open the call to Ben Cohn. Ben, please go ahead.
Thank you, Ashley, and good afternoon, everyone. So much has changed with the company since we last spoke in November that we want to level set where we were where we are, and where we are going. We are one of the most valuable brands in the world, Playboy. This is a brand that drives billions of dollars in consumer spend and has almost 100% global awareness. Our business is now on solid financial footing post our $70 million debt paydown. We also have additional levers we can still pull internally to build additional cash reserves or pay down more debt should we choose to, without raising more equity at today's prices. To maintain our current financial flexibility, we are changing our business model and moving to a capital-light model with a singular focus on Playboy and Honey Birdette. Our new model gives us a combination of strong cash flow from our licensing segment, high growth potential through our creator platform in Honey Birdette, and less operational complexity by eliminating non-profitable business units and non-core assets. Within Playboy, we are focusing on two things. First, our licensing and strategic partnerships business. The business has a lower risk profile, $346 million of future royalty guarantee payments through 2031, high quality recurring cash flows, and the opportunity to be much larger than it is today. We intend to scale this business through a JV approach to supplement licensing's current high cash flow generation and to optimize it globally. In 2022, the licensing business produced approximately $61 million of revenue, and we believe through the right partnerships, we can more than double this business over the next few years. Second, our creator platform. This is our hero Playboy product moving forward, and it returns the company to its roots as the place for creators to be seen and discovered. The business is growing at over a 9% weekly CAGR since relaunch in mid-September 2022, with pro forma annualized weekly GMV already in excess of $15 million. We are approaching monthly cash flow break even with our fixed costs under $500,000 a month. At Honey Birdette, we are excited about the future and believe there is a huge opportunity for growth in the U.S. and Europe. In 2022, our U.S. stores generated 38% four-wall EBITDA margins, not including the incremental e-commerce they drive in their local geographies, and we see a total market opportunity of at least 100 stores domestically. Given our capital-light model, we are engaging an advisor to raise growth capital at the Honey Birdette level to accelerate the execution of our growth strategy. This new focus on these three units is the right direction moving forward, and one I am confident we will be able to execute. When we went public in 2021, our investor base and expectations were different, and the capital markets were happy to accommodate different growth-focused business models. The world today is different, and we believe our new business plan aligns well with what we have heard from our current investor base, which is capital light, higher margin, simplicity of execution, and making sure we have sufficient runway to execute on business priorities with less financial leverage. The first step to transform the business model was to deal with the debt burden and ensure we have more than a sufficient runway to execute on this transition. Management and our board are aligned with our shareholders and believe in our business model moving forward. It's why I invested over $1.2 million and why Rizvi invested almost $30 million in the rights offering. We paid down $70 million of debt over the past 3 months, which in turn significantly reduces our interest expense moving forward. Now that our balance sheet and liquidity are more secure, I want to discuss what we won't be doing. First, on the cost side, we eliminated $18 million of annualized costs last year and have identified a minimum of $15 million of additional annualized cost cuts, $10 million of which we implemented this week. The rest will be accomplished as we continue to simplify the business. In addition to the $15 million, we expect additional direct cost reductions related to the sale of business units. Second, we are very close to selling Yandy and expect the deal to close in the coming weeks. Third, we have also done a strategic review of our Lovers business, which we bought for approximately $25 million or roughly 5 times EBITDA at the time. Lovers is still producing roughly the same cash flow as when we bought it, and we will be reviewing strategic alternatives for Lovers' future as part of the PLBY group in the coming months. Lastly, we have grown Playboy e-commerce from basically zero in 2020 to $22 million of revenue in 2022. But given the cost to build a team, develop private label products, and acquire customers, the business still lost in excess of $7 million in 2022. Given the losses and operational complexity, we are exploring alternatives to significantly reduce or eliminate those losses altogether. One alternative would be to convert the business to a JV or licensing deal. The second would be to shrink the revenue and SKU count and significantly reduce paid marketing. In both scenarios, the products will still be available at our website and our customers will not experience any change. We will use our creator platform as the primary way to market the products. After such a restructuring is complete, we would expect to have a much simpler business model and one that allows us to have laser focus on our core licensing business, our creator platform, and Honey Birdette. Assuming the intended restructuring is completed, all of our business units are projected to become profitable. We have posted a new investor deck to our investor website that outlines our focus moving forward, as well as pro forma revenue and costs for what the business would have looked like last year had the restructuring occurred. Lance will give you more details in a few minutes. As I said earlier, our focus moving forward is in 3 core areas. First, our creator platform. The creator platform is the most strategic and high growth potential business we could have invested in over the past year, and is truly differentiated from the competition given our brand and what that means to creators. So why is this so strategic? First, it returns the companies to its roots as the place to be and be seen for creators, and it brings heat to everything we do in the future. Second, it creates a flywheel for the rest of the business because those creators bring their audiences to Playboy, allowing us to sell those audiences other products, whether they are our own or from our licensing partners. And third, the business scales very quickly, and the long-term cash flow dynamics are superb. We have limited fixed costs, and our revenue is 20% of GMV generated by the creator. We believe over time there are other value-added services we can offer to increase that percentage. I'm excited to share some early numbers since the September relaunch that signal the platform's progress. We have registered about 1.4 million users to the platform with no marketing spend. If you annualize your weekly GMV today, assuming no growth, we would do over 15 million in GMV this year. And that's with only about 1,500 active creators. However, our weekly growth in GMV since relaunch has been over 9%, with that growth rate accelerating over the past 4 weeks to over 18% weekly, as the network effect starts to take hold and we have increased the number of new creators joining. There have been 40 million messages sent through the platform. Users are coming to interact with message with creators. Our average earning creator is on track to generate over $12,000 in GMV per year, and our top creators are on track to generate GMV well into the millions. The vast majority of our creators earn money via connecting with their fans with safe for work content and conversation. Based on reported data, our understanding is that Playboy creators are earning multiples of what average creators earn on competitive paywall platforms. We've achieved this progress for 3 key reasons. First and foremost, as I talked about in our last earnings call, we now have a world-class product and technology team. Our product today is on par with our competitors from a feature and functionality perspective, and has been built with the capacity to scale and innovate much faster. Just last Friday, we rolled out new profile designs to further enhance the creator and user experience. We also improved our search functionality to support our creators in expanding their Playboy fan bases. The second driver of our recent progress has been quickening the pace of accepting creators onto the platform from our waitlist. Tens of thousands of prospective creators have now applied. With the recent migration of the platform to Playboy.com and expanded grassroots promotion, we are hearing incredible excitement within the creator community that Playboy is their top choice platform. Something important to note here is that we hear from our creator community how excited they are to be part of an elevated and exclusive platform, one that does not allow the explicit content that our biggest competitor does. And most importantly, they want to be part of a platform that they are proud to show off. Being accepted to become a Playboy bunny is now something the creators are so excited to promote across their social media platform. This point of pride is something that no one else can replicate. And third, our in-house creator team has been hard at work building out creator success tools to support those creators we accept onto the platform. We see an enormous desire from our creator community to participate in the full Playboy lifestyle. And we've begun testing perks for top performers, such as the opportunity to model in Playboy fashion campaigns, attend Playboy events, and more. As you may have seen, we just announced the return of the ultimate perk for creators, the chance to be featured in the Playboy magazine. Unlike so many creator-led platforms trying to scale, we have a formidable and unreplicable tool, the magazine. We will be bringing back the magazine in a digital-first form to serve as a huge promotional platform for our top creators, as well as to continue working with celebrities across Playboy covers and editorial features to drive big traffic numbers into the platform. We are thrilled to tease the new magazine experience with the release of the Playboy cover sheet featuring one of our top creators, October 2011 Playmate, Amanda Cerny. Amanda's fans can also pay for special access to behind-the-scenes content on her own Playboy channel. Here's what to expect from here. First, we will continuously improve the product experience for our creators and their fans. For creators, we are focused on making it as easy as possible to make money and to grow your fan base to make even more money. For fans, we're focused on making it as seamless as possible to find your favorite creators to follow and support. We've begun exploring how AI tools can optimize the creator and fan experience. Second, we are always working to enhance our value proposition to creators. And this is where the digital magazine comes in. We will be rolling out more editorial-like features for top creators for the chance to truly feel like they made the cover of Playboy. In addition, creators will soon have expanded opportunities to become Playboy fashion affiliates across Playboy and Honey Birdette. Our goal is to continue to scale our creator base, ensuring maintaining Playboy's high standards of representing our brand. By year end, I would like to get to 10,000 creators earning money on the platform. And lastly, across all areas of our organization, including licensing and Honey Birdette, we are working to leverage our creator community as built-in organic marketing machine. We expect creators will make more money on Playboy than any other platform by becoming affiliates and being paid for selling products. Our Playboy creators deliver big brand buzz and drive meaningful monetization from the audiences they attract. Further, they are the embodiment of the aspirational lifestyle that both Playboy and Honey Birdette brands represent in the world. Our second core area of focus is our licensing and strategic partnership business. We made significant progress on a number of fronts during 2022 on our strategic partnerships and licensing business. I recently returned from Hong Kong after not traveling there since COVID-19 started and met with our largest licensing partners. 3 years ago, we began setting the stage to transform our business in China from an outsourced licensing business with limited sales and distribution visibility to a joint venture operating model that gives us more control of the brand and brings us closer to the end consumer. As part of this evolution, we met with the Fung Group 3 years ago. And while it took longer than anticipated given the impact of the global pandemic and China's zero COVID policy, we are now pleased to report that we have partnered with the Fung Group Retail Brand Management Unit for China. The goal of the Playboy China is threefold. First, partner with trusted operating teams in China with experience across apparel, supply chain, product design, retail execution, brand marketing, trademark enforcement, and above all, strong relationships with the online sales platforms in China. It is not our intent to directly operate a retail or e-commerce business or take on the financial burden associated with inventory and operational complexity. Our goal is creating a best-in-class, in-country team who truly understands the China market and has the right experience and relationships to hold our licensees accountable and replace them should the need arise. 2 weeks ago, we began the process of establishing new ground rules with our licensees for how and where Playboy branded products are sold to ensure greater consistency and control across the market. This includes potentially restructuring our agreements so that from a financial perspective, the JV will manage the flagship e-commerce stores to track online sales and ensure quality control and design across all Playboy branded products. In essence, our licensees still supply approved products and keep inventory, but the JV will control the gateway to the consumer and the overall brand experience. The JV will enable us to work together with the e-commerce platforms to control how Playboy is sold and ensure the JV is capturing online sales data and enforcing shutdowns on counterfeiters and unauthorized stores. Second, have stronger relationships and broader reach to take advantage of emerging product categories that Playboy has not entered to expand our lifestyle offerings and accelerate growth. In just a few weeks, our new JV partner has developed the strongest and most diverse new business pipeline we have seen in years for China. Third, reduce the operational burden by transferring our management, product approval, and legal complexity of operating in China to a highly experienced partner in the local market. Finally, the China JV structure has allowed us to significantly reduce the amount we pay our licensing agent on a cash basis and enables our new partner, the Feng Retailing Group, to earn up to 15% ownership of the China business at a $250 million valuation. We believe the JV we have established in China is a good model for other parts of our licensing business, especially as we think about when our contract expires in 2028 with our global licensing agent, which we were paying approximately $9 million annually to. We have over 180 licensees, and trying to manage them from California is no easy task. Operationally, the JV model allows us to do less at corporate while gaining region or product-specific expertise for business growth and management. We are currently looking to take this JV model to other parts of the world or product categories where we see huge growth potential. Another JV we established was with our spirits partner. In addition to the $13 million they previously raised, they have commitments for up to another $20 million of additional investment. We own 20% of the operating spirits business on a fully diluted basis, plus we generate an annual license fee. To date, Playboy Spirits has launched limited edition collector items in the bourbon, tequila, and cognac categories. What we are most excited for is the launch of ready-to-drink cocktails later this year. Again, we are partnering with a management team that have domain and operating expertise and leveraging their organizations to build businesses which not only pay us a licensing fee, but also provide us with the equity upside. Lastly, our Playboy Pleasure line of products is off to a great start at Lovers stores, generating on average $100,000 in weekly sales only at Lovers. We set this up as a licensing deal and plan to aggressively expand that product line and distribution with our partner. We have already secured over 1,000 third-party retail locations to carry the product starting this week. Let's talk in more detail about Honey Birdette, our third core area of focus, because I continue to believe that business is a billion-dollar opportunity based on the current revenue and EBITDA growth profile. When we bought Honey Birdette in 2021,
no one cares what you think, Ben.
The business was doing approximately $73 million in revenue on a trailing 12-month basis and grew to $84 million in 2022. Although 2022 was a very tough year with significant inflation that we believe affected demand, inventory overbuys, supply chain issues, as well as competitors discounting, the brand remains extremely strong. In the first 3 quarters of 2022, we had to discount our inventory more than the business had historically, given the macroeconomic environment and excessive inventory purchase prior to our acquisition of Honey Birdette. Starting in Q4, we made the decision to limit promotional activity moving forward and to focus on brand health. It was a tough decision from a financial perspective because even at discounted prices, it is still a high margin business, but it's the right long-term brand decision. The stores we have opened in the U.S. over the past year are off to a great start. Our average store in the U.S. is producing over $1 million annually, which is double the average store in Australia, with our best store doing $1.8 million. In the U.S., we are averaging a 38% four-wall EBITDA margin compared to 34% in Australia. Average order volume, or AOV, in the U.S. is $230.
This is all on page 21.
$135 in Australia. The U.S. now represents 38% of the total revenue, and Australia 49%. Given the attractive economics, we believe there's a long-term opportunity to open more than 100 stores in the U.S. We hope to open 4 to 6 new stores this year. It takes time to find the right mall location, especially given our small footprint of 800 to 1,000 square feet. Before I turn it over to Lance, I want to set the record straight on some misperceptions and reiterate why I'm excited for the future. First, I and the named executive officers have never sold a share of stock for personal gain. The company does not net settle equity grants as other companies do, as the payment of employee taxes would be a drain on balance sheet cash, and hence forces the employee to sell shares of settled grants to pay the applicable tax. The only stock we have sold is to pay the taxes required with the exercise of options or settlement of other grants, as is legally required. In fact, I have bought stock personally 3 different times since we went public. The last time is part of the rights offering, where I invested over $1.2 million and Rizvi invested almost $30 million. Second, I want to clarify how stock-based compensation is accounted for in the financial statements. All equity grants are initially valued based on the value of the underlying stock on the date of grant, applying different valuation models to different kinds of grants. Expense for equity grants is accounted for both as of the date of grant and each quarter thereafter for the remaining life of the grant, in each case based on the grant date valuation, regardless of subsequent changes in market value of the underlying stock. Thus, even in quarters without equity grants, the company is required to show expense for existing prior grants based on their initial valuation. The quarterly stock-based compensation expense is not compensation of an award holder divided by the then current share price. Further, such quarterly expense does not mean there is any new or additional compensation to existing grant holders, nor any additional dilution related to the quarterly expense. The last time our executive officers received any grants was in April 2022, and quarterly expense for the life of those grants will be based on the valuation as of April 2022. Moving forward, we will have a much simpler, less capital-intensive business with the right combination of cash flow from our licensing business, coupled with potentially significant growth in cash flow from our Creator platform and Honey Birdette. We have a manageable amount of debt, a substantial amount of cash on our balance sheet, and the ability to generate extra liquidity via the sale of non-core assets, including our extensive art collection. In my opinion, our current valuation is very dislocated from the immense value the sum of the parts represent, including our lucrative brand, PLBY, our approximately $300 million of federal net operating losses, our extensive art and archive collection, the present value of our forward booked licensing revenue, and the value of Honey Birdette. We believe in our business plan, but should it not materialize in the way we believe it will, then we will explore appropriate strategic options to maximize shareholder value.
That's what we wanted to hear. They're going to sell the business when they fail.
Before I turn the call over to Lance, I want to thank him for his partnership and hard work over the past 2 years. Lance will be departing the company in Q2 and will work with us to ensure a seamless transition. Lance helped us lead us through a period of growth and transformation as a newly public company, and we wish him the best in his future endeavors. Lance?
Thank you for the kind words, Ben. It has been a privilege to be part of such an iconic brand, and I'm grateful to the entire organization for all that we've accomplished. I continue to believe in the potential value of this company, and I'm excited for the team to execute on this new strategy. Given our restructuring plan, I will briefly touch on certain Q4 results and then discuss what the business looks like pro forma, taking into consideration all of the plan changes. In the financial slides of the presentation that we've posted to our investor site, we've provided more granularity on full-year revenue by brand within each of our reporting segments. We've also provided total company annual costs on an as-reported basis, a non-GAAP adjusted basis, and a pro forma basis, after stripping out the costs related to the businesses that we no longer intend to operate. Fourth quarter results were impacted by a number of factors. One, we didn't execute as well as planned on our IT system implementations last year, which disrupted fulfillment operations and resulted in increased costs to remedy. Two, we pulled back aggressively on performance marketing due to both continued softness and efficiency and the aforementioned fulfillment challenges. 3, macro headwinds persisted, impacting consumers and partners alike, along with $1.6 million of lost revenue due to foreign currency exchange rates. And 4, reduced promotional activity at Honey Birdette led to lower sales, while increased promotional activity to liquidate inventory at Playboy and Yandy led to lower product margins. Total Q4 revenue was $68.5 million, a decrease of $27 million year over year. Of the total revenue decrease, $13.4 million came from the direct-to-consumer segment, $1.7 million from licensing, primarily due to a reduction in overages received, and $11.4 million from digital, reflecting no NFT revenue in the fourth quarter of 2022. Now turning to the restructuring. Our investor presentation shows both revenue and costs on a pro forma basis for what the business would have looked like in 2022 had the restructuring been done at the beginning of last year. Overall revenue would have been $212 million, less the $73 million cost of sales and $113 million of selling and administrative expenses would have resulted in just over $25 million of pro forma EBITDA. This pro forma assumes no revenue or costs related to Yandy or Playboy direct-to-consumer. It also assumes that the additional $15 million of cost savings we have identified are removed, along with $3.5 million of creator platform upfront launch costs that were one-time in nature. The pro forma selling and administrative costs do not remove any other incremental costs related to the creator platform, which were roughly $8 million in 2022. There was also no annualization of revenue or cost for the Honey Birdette stores we opened at various points during the year. For 2023, we are not giving specific guidance at this point, given the restructuring is ongoing and some of the timing related to sale of assets is a moving target. The primary differences between 2022 on a pro forma basis and 2023 relate to 4 areas. First, we plan on opening 4 to 6 new Honey Birdette stores, mostly in Q4. Second, we are going to continue to protect the Honey Birdette brand and will not be discounting merchandise outside of our normal pre-COVID sale periods, which will make the first 3 quarters of 2023 a tough year-over-year comparison from a revenue perspective. Third, we are seeing signs that our creator platform is beginning to scale and believe it will be cash flow neutral to positive for the year. And lastly is related to the timing of when certain cost reductions or exits of businesses occur, as we won't get a full year benefit of some of these actions. With the successful completion of the rights offering, we have reduced total leverage, eliminated our minimum cash covenants entirely, and eliminated leverage covenants to the second quarter of next year. In the last 3 months, we've paid down $70 million of debt in addition to the quarterly amortization payments, and currently have $157 million of total debt outstanding, with approximately $35 million of cash and equivalents on the balance sheet today. We have no exposure to Silicon Valley Bank or Signature Bank, and our cash is held between top-tier financial institutions in the U.S., UK, and Australia. Our debt service for the year is expected to be approximately $19 million. We believe that our current balance sheet, covenant waiver through the second quarter of 2024, and our focus on managing the business for cash flow gives us ample runway and liquidity to continue executing on our plans for Playboy and Honey Birdette. With that, I'll ask the operator to please open the line for questions.
Thank you. Ladies and gentlemen, at this time, we will be conducting a question and answer session. If you'd like to ask a question, you may press star 1 on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star 2 if you would like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star key. Our first question comes from the line of Alex Furman with Craig-Hallum. If everyone could please limit themselves to 1 question and 1 follow-up so we may get to everyone's questions. Alex, please proceed with your question.
Hey guys, thanks very much for taking my question. I'm trying to understand a little bit better the pieces of the business and how much they might be worth, especially now that it sounds like you're going to be focusing just on Playboy and Honey Birdette. I think Honey Birdette is, an easy enough business to understand, but the Playboy brand shows up across different categories and regions and business models. Can you give us a little bit more color to help us size up the value of those different pieces? I think you'd recently said there was a third-party valuation of $250 million put on the China licensing JV, of which you own a majority of that. But how can we think about the value of the Playboy licensing business outside of China, as well as Centerfold, some of the legacy Playboy TV and Plus assets, as well as just the option to enter new categories and regions where you're not currently in?
Hey, Alex, it's Ben Cohn. Thanks for the question. Look, there's multiple different ways to value Playboy. Playboy is one of the largest brands in the world and basically has 100% unaided global awareness. When I think about the components myself and what led me to, write another check into the company, I think about the present value of our licensing business. That is the business that is underexploited today in a lot of parts of the world. So I think, as we mentioned in the beginning, we have roughly $346 million of forward book cash flow. Those are only minimum guarantees. That doesn't include overages and other things. And then what would be the terminal value on that? We've talked about our art collection historically. There are, our Playboy TV, our Playboy Plus business, which are legacy businesses, still generate cash flow. When you think about the value of the creator platform that we're building, and it's off to a good start, if you annualized our weekly GMV today, you would get in excess of $15 million. And if you looked at that growth rate, it's growing at a 9% weekly CAGR. And so when you look at the cash flow that generates, we talked about the $500,000 of monthly fixed costs, and that we take 20% of what our creator makes. And so that business starts to scale when that business starts to scale quickly, the amount of cash that can spin off is absolutely huge.
The last piece that I don't think you mentioned then was Honey Burdette. If you remember, we paid around $300 million for that. Obviously, it was a different time, but when you think about, we've grown revenue since we acquired it, and you can think about EBITDA margins on that business being quite healthy. Put a price on it, but I think again, you could probably get a pretty decent value for Honey Burdette as well.
Okay, that's really helpful. Thank you both. And then, Lance, if I could drill down more on the pro forma calculations that you put out in your deck and kind of sketching to that $25 million of pro forma EBITDA. Can you help us unpack that a little bit more? I mean, you mentioned a few things this year that are going to be different between that kind of hypothetical pro forma number and the reality of 23, some comparisons on Honey Burdette and changes in Centerfold. And it sounds like, if I'm hearing those correctly, I mean, it sounds like some of those differences, are going to net to an improvement versus the pro forma results. I imagine the majority of those changes, specifically the fact that it's going to take some time to realize the cost reductions, probably mean we're not going to see that full $25 million this year. But can you just help to size that up a little bit? I mean, if you kind of straight line, the cost savings that you outlined, I mean, do we kind of get to that $25 million, at some point early next year on a run rate basis? I mean, how should we think about, what you're actually going to go through this year versus that $25 million number?
Sure. Yeah, there's a few different ways to think about it, but you're absolutely right. Part of this is a little bit timing, right? We're now sitting here mid-March. We've implemented some of these cost-saving measures. We haven't fully exited Yandy yet. We haven't completed kind of what we need to do on Playboy direct-to-consumer. But the way I think about it is really when you look at it on a go-forward basis or a call it future 12-month or next 12-month basis, your baseline is kind of that $25 million once you've implemented all of these changes. And then the other things that aren't really contemplated in that would be you're still being burdened with that $25 million. You're still being burdened by $8 million of losses in the 2022 pro forma from the creator platform. So if you're able to get that to break even, that puts you, closer to $33 million on a go-forward basis. To the extent you're able to get incremental revenue and EBITDA from opening, like we said, 4 to 5 new Honey Burdette saying you would net out a little bit on Honey Burdette would be the drag for the first 3 quarters this year as we take out promotion. But yeah, I would say net, when you think about this, a very clean structure on a go-forward basis, you're looking at kind of a baseline level of EBITDA, well into the 30s, and hopefully we can optimize it even further from there.
Yeah, Alex, Ben, on the cost side, we've identified $15 million today. We believe there's more cost to actually take out. It's something, I've done for 25 years in private equity when we go into businesses, and we are rebuilding this business line item by line item. But of that $10 million was done this week. So we won't get the full annual benefit of it this year because it's already March 15th, but we've eliminated $10 million as of this week. And then the other $5 million will be coming, shortly hereafter as we continue to simplify the business. And then I hope there are more costs that we can continue to take out as we simplify the company, really looking, less at the personnel side of things, which was done this week, but more at our vendor contracts moving forward. I think there's precedence out there in the marketplace from other companies during these economic times. And I believe there are significant savings that we can have. And, we're getting down to literally like the logistics at Honey Burdette. And so when you think about our warehouse operations, you think about how we ship product out, eliminating a box and going to a PLBY bag. These are hundreds of thousands of dollars of savings, and we are literally rebuilding everything from the ground up.
Okay, that's really helpful. Thank you very much.
Our next question comes from the line of Mike Hickey with the Benchmark Company. Please proceed with your question.
Hey, Ben, Lance, Ashley, thanks for taking my question, guys. I guess first, Ben, on your creator platform, obviously you seem very excited here with some early success. Obviously, still early days, but it feels like this is likely exceeding your expectations. Curious if that's true or not. And then on the GMV, can you sort of maybe a little bit more granular on drilling down on what that actually means in terms of revenue generation? I've got a follow-up.
Sure. So I think we have something that is truly differentiated from any of the competition we have seen. So when you think about the PLBY brand, the one thing we have heard from creators from day one is they want to be on the pages of PLBY. And so if you look at the recent changes we're making, and there's a lot of technology work being done in the background that has not rolled out or might not be visible to the consumer. But I think we have something truly differentiated with our brand. When I look at the business and how it is scaling, since we relaunched in mid-September, are growing at a 9% weekly CAGR. That CAGR has increased over the last 4 weeks to 18%. If you annualized our weekly GMV today with no growth, so just took the weekly GMV and annualized it, you would be in excess of $15 million. If you actually applied the 9% weekly growth, and we're not assuming that continues, but if it did continue, you would get to roughly $135 million plus for the year of GMV. And then we take 20% of that. And so, as we said, our direct fixed costs associated with the business are roughly $500,000 a month. Depending on what that GMV turns out to be for the year, we believe the business will be cash flow neutral to positive, and then continue to scale from there. And so there's a lot of stuff that we have planned from a product perspective. But when we started this and we decided to re-platform the business last year, the benchmark or the baseline that we thought we had to be at was to have a product from a technology perspective that was as good as the competitors. And I believe that over time we will have a technology platform that will be better than the competitors based on the team we have, the way it is built, and what we can do with it moving forward. And then when you add that secret sauce of bringing back that digital magazine, that can be a huge traffic driver to the platform, just like it was historically for the company, because you are working with mainstream celebrities, to be on the pages of PLBY. And when you start to think about the traffic that generates, we've already brought in and signed up 1.4 million people have registered on the creator platform And we've spent no money marketing versus when you look at the consumer products business, what you're spending to acquire customers, over time this year, our creators will become affiliates for the consumer product business on both Playboy and Honey Birdette.
Nice. Thanks, Ben. Good luck, man. It's really exciting. Congratulations so far on the growth there. I guess the second question, Lance, I realize you're exiting. Sorry to hear that. Just met you. Now you're heading out, but good luck to you. Curious on 23. I realize you're not guiding. There's a bunch of moving pieces. We can sort of compute the $25 million and 12% margin there. But I guess as you sort of see the momentum in your business and you sort of baseline that across the segments you're going to keep, and you sort of think more medium to longer term, do you have a sense of target EBITDA margin that you sort of want to track to? And then last question, I guess on Lance leaving, what sort of process are you guys going to go through to sort of bring someone else, if you're thinking internal or external, or how you're going to approach replacing Lance? Thanks, guys.
Sure, I'll touch on the EBITDA piece. The way I'd look at it is probably on a segment-by-segment basis, right? If you look at direct-to-consumer, it's really been weighed down, through the Andy business and as we've tried to start up the Playboy business. So if you're eliminating that, and you're really just left with Lovers and Honey Birdette, that's a segment that could be doing around 20% margin. If you got rid of Lovers and just focused on Honey Birdette, that EBITDA margin would actually be higher. If you look at the licensing segment, those EBITDA margins are incredibly high. I think, well north of 70%, 75%. And then the digital segment, as Ben mentioned, right now, you think of the creator platform is getting to break even this year. We actually have two other businesses within the digital segment. That's TV and Plus. They did $18 million, $17.9 million of revenue last year. Now they're in decline, but those businesses, from an EBITDA margin perspective, are north of 40%, 40, 50%. They're really high margin businesses as well. So I think the question on digital longer term is, what would the creator platform margins look like? We've seen historically, when we launched the NFT project, that was incredibly high EBITDA margin when we generated $11 million of revenue in the fourth quarter of 2021. So look, we think that could be an incredibly high margin business going forward. But, in terms of like a next 12 months, I think of it as more break even for the creator platform plus the benefit you're getting from TV and Plus.
Yeah, I think when there's, the largest competitor in the space, the numbers are out there publicly, and I think you can look to those margins for what the platform could generate. And so, what we talked about on the creator platform is the $500,000 of fixed costs. There are some variable costs with credit card fees, et cetera. But, if the business were to continue its growth at 9%, and do $135 million in GMV, or roughly $27 million to us, I can tell you flat out it's very profitable, right? And the margins are extremely high because your fixed costs don't really scale. And then, as far as Lance, it's something the board is working on, and we're obviously looking moving forward, for the best CFO we can hire at the business.
Thanks, guys.
Our next question comes from the line of Jason Tilchen with Canaccord. Please proceed with your question.
Yeah, thanks everyone, and for taking the call. I guess the first thing I was curious about is if you could shed a little more light on the financial impact of moving the China licensing business to the JV over the next 2 quarters. Is there any change there? And then sort of longer term, What are some of the other? I know you mentioned there's some additional markets that you think that sort of been under penetrated by you guys in the licensing area over time. I'm just curious if there's any more color you can share there on which countries you're referring to and how near term those opportunities are. Thanks.
Sure. So I think for China, as I think about China for the year, I don't see any financial impact, from moving from what we were to where we are going. In fact, when you think about how the deal is structured, and we talked about this a little bit on the call, moving from what was a cash licensing fee to allowing our partner to earn equity based on performance in the business at a $250 million valuation. And then we think about the growth that they are bringing to the table through that business pipeline. I would hope over time that business will grow. There's a ton of categories within China where we're largely a men's fashion brand and have been. And some of the business pipeline we've seen, especially around women's and then accessories, there's a lot of opportunities for growth within that market. When we think about other places in the world, the JV approach that we've done, we believe that running the business the way that we did because of some legacy issues with the global agent is not the most ideal or optimized way to run it. And so we think about other parts of Southeast Asia. When you get into Vietnam and Thailand, you get into Japan and Korea where the brand is extremely strong. India would be another area that, now that we're post-pandemic, we're very focused on. And then Europe, we are still relatively small in Europe, and we think there's opportunities there as well.
It's very helpful. And just a follow-up, or actually two quick follow-ups on the creator platform. I believe you mentioned called it digital first, but not digital only in terms of relaunching the magazine. I'm just curious if there's anything to read into there about potentially doing some sort of limited opportunities in a paper format. And then secondly, the user growth is really impressive with your marketing spend. Are there any plans to get more aggressive on the marketing side now that you're rebranding it under the Playboy umbrella?
So as far as the marketing, I don't really want to speak at this point to our marketing. I think that we're seeing great success with creators bringing their audiences to Playboy. Obviously, there was some press this week on the magazine, and the inbound phone calls from creators wanting to be part of that magazine has significantly accelerated. And I'll say this on the Digital First magazine, I choose my words carefully, and we choose our words carefully. And so I'm not interested in selling magazine copies. That's not a business that we want to go into. But if getting a magazine was part of a larger play and being a Playboy member, then that at some point can make sense for us.
Great. Very helpful. Thanks a lot.
Our next question comes from the line of Jim Duffy with Stifel. Please proceed with your question.
Thank you. Good afternoon. Much appreciated details in the presentation. Thank you for that. Great additional disclosure. I wanted to start by digging in on the economics of the creator platform. You're at a $15 million GMV run rate, fixed costs around $6 million. You get about 20% revenue attribution. What are the other variable costs, and how much above that 30 million GMV run rate would you need to get to break even on that business?
So, thanks, Jim. It's Ben. So when you look at the business, we take 20% of what the creator makes. We talked about our fixed costs. So the run rate right now, assuming no growth, is 15 million, right? With the 9% weekly CAGR, we are growing that. The fixed costs, roughly $6 million for the year. And then the variable costs for that business are based on your credit card processing fees for the most part.
And hosting.
And the hosting, but that doesn't really increase substantially, based on the deals we have. So it really comes down to credit card fees that we believe we're in the process of reducing. And so if you get to call it a high single digits, very low double digits business, you are breaking even to making money.
I'm sorry, I don't understand the high single digits to low double digits. That's the margin.
A million. So if your fixed costs are $6 million, and I don't want to get into all the specifics of the credit card fees, but when you start to get to high single digit millions, right? You have $6 million of fixed costs. You put a variable cost on that, so you get into the upper end of that.
You're saying not GMV in the high single digits. You're seeing revenue contribution. So you'd be doing 5x the revenue contribution in GMV.
Correct. So if you're doing $15 million of GMV today with no growth moving forward, that generates $3 million of revenue to us. And so the business is growing at 9% weekly CAGR since September, 18% over the last 4 weeks. And so when you start to extrapolate that out from a growth perspective moving forward, if you grew at that 9%, you would do 135 million of GMV or 27 million of revenue for us, right? Then the business is very, very profitable. If you were doing $50 million of GMV, that's $10 million of revenue to us. We are making money.
Okay, I follow you. What are the incremental areas for investment in that business this year? What's, for instance, what's the cost to relaunch the magazine? Are there any other platform expenses we should think about as components of the cost base?
No, our costs are pretty much fixed at this point. It's really the internal team that we have built and the engineers that we have hired. And so, outside of that, I don't see any other costs. And I don't want to talk about the product roadmap because technology product roadmaps always move. And if I put something out there, I will disappoint someone and then competitors. But what I will say is we have a very detailed product roadmap moving forward to continue to enhance the experience for the creators and for the users. And we launched a new profile that has been very well received with creators last week. We launched an enhanced discovery as what I would say is really step one in discovery with a lot more coming. And then there's a number of other product features as we look to consolidate what I would say is, one-off or standalone other legacy products that we have into one ecosystem moving forward. But our fixed costs will not increase with that.
Okay. And then my next question, I wanted to ask about the business model change for PLBY D2C. What's the time frame in which you'd expect to execute on that?
We are exploring
a number of different options.
Yeah, we're executing on the cost side of it right now. And so we talked about the $10 million of cost that we've taken out this week. And so we have to focus on what we can control. And as far as making a final decision on whether or not we operate it with a reduced revenue and SKU count or a JV, that is something that is ongoing in real time right now. And we'll make that decision here, in the short term, moving forward. But what we are committed to doing is I'm committed to generating as much EBITDA out of the company as we can generate. We think we have a good baseline now, as Lance talked about it, and we want to make sure that all of our business units are profitable. So we know we have a high cash flow and high margin licensing business. We have a fast growing digital business in the creator platform that should be high cash flow and high cash flow margin. And then, Honey Birdette, we talked about the growth in the United States, especially generating 38% four-wall EBITDA margins in the United States on average. And so when you add that all up, and as we've reduced the corporate overhead and simplified the business, and we'll continue to do that, we are focused on making sure that on the net cash basis, after debt service, after cash taxes, even though we have $300 million of NOLs in some foreign jurisdictions, and after CapEx, that we are running this business to be cash flow positive after everything. And that is our goal, is to continue to build cash and continue to delever the company.
And this is Ashley. I'll just jump in really quickly on what Ben noted. So as he mentioned, today we made some really hard decisions internally, which right-sized our personnel structure for PLBY.com. We started really in Q4 aggressively, but most aggressively in the last month or two, significantly reducing our paid media spend in PLBY. So we've already started that massive reduction, which will obviously have big top line impacts, but that will help us get to a position of, much significantly less losses than what we incurred last year. And that work's been ongoing and will continue as we identify the future operating model.
We have time for one last question. The last question comes from George Kelly with Roth Capital Partners. Please proceed with your question.
Hi, everybody. Thanks for taking my question. So first one is just another question on the creator platform. I just want to make sure I understand all the math and everything around it. So I thought I heard you say in your prepared remarks that you expect it to be sort of a neutral impact to cash flow this year, break even. And so am I doing the math right if I take that to mean that you expect an average run rate GMV during the year of around $50 million?
That would be, it's slightly less than that, but that would be a fairest estimate. Than when you look at sort of where we are today at 15 with no growth and where we expect to be, that's what we think.
Okay, that's helpful. And then second question for me on Honey Birdette, you mentioned about the sort of changing pricing strategy there in 4Q. I was just hoping you could give a little more disclosure about what the revenue was in 4Q and what kind of growth year-over-year growth rate that was.
Yeah, and George, the one thing I'll say, just so when you go back to the pro forma, and I'll let Lance answer the HB, but when you go back to the pro forma, remember that $25 million of pro forma EBITDA is still being burdened with $8 million of cost for the creator platform. So if the business is cash flow break even, it's the 25 plus the 8 million that gets you to 33 million that Lance was talking about.
So it was around 18 million revenue in the fourth quarter, for the full year, the U.S. was up, Australia was slightly down. The U.S. was up by, on a full year basis, 22% for the year.
Yeah, and I'll jump in quickly. This is Ashley again. I'll just jump in on the promotion shifts that were made and the actions that started taking place in Q4. As Ben spoke to, the first 3 quarters of the year, we added 2 incremental promotions. Those promotions happened in March and September. With the September promo, that was leading into Q4, whereas as we hit in the Q4 period, we had 60% less breadth of product on promotion, and we reduced the depth of discount. So there was a timing shift in September that ended up pulling forward some sales. The way I'm looking at this and how I've normalized it is I've combined Q3 and Q4 because we essentially reduced promo starting in Q4, which is going to continue into this year through the Q3 period. But when you combine those periods, if you look at it on a constant currency basis, we're up roughly 2%. When you add in that kind of Q3, Q4, which accounts for the timing shift. We are going to pull out for this year the March promotion. So we are obviously in March right now. We are in the process. It's happening now. We've pulled it out. And we will also reduce the September promotion. We will not do it. And so we will only offer the June and the November sale, which is consistent with our kind of pre-COVID period, and then the Boxing Day. And so we're anticipating the revenue impact of that, but that's going to bring us to a much healthier business and position us for longer brand term health.
Yeah, George, we cut back our inventory buys substantially. And so therefore, the inventory that had been bought prior to our purchase that we had to work through last year, especially with the macro climate and Australia specifically, because we've been started managing our inventory early last year, and we have about a 9-month lead time on inventory. we don't have that, and what we want to put forward more than anything is the brand health of HB, which is extremely strong as a luxury brand, and making sure that that customer does not get conditioned to buying things on sale, and especially given the high margins we have at full price.
That does conclude our question and answer session. This does conclude our call.
All right.
Thank you for your participation. You may disconnect your lines at this time, and have a wonderful day.
I hope he has a wonderful day as well. Lovely. So, with all that having transpired, Joe, when we bring you up, I'm going to just start clicking people's names who I know might be interested in speaking, and if they opt to come up and speak, so be it. If they decline, so be it. Folks I know who either are or have in the past been invested in PLBY. So I guess I'll give my take real quick. It's disappointing that the CFO is leaving and not the CEO. It's, I guess, nice to hear that they've finally provided some operating metrics for Centerfold, their creator platform, whatever they're going to call it now, that the implication from what we kind of heard them sussing out in the Q&A is that they think, based on the current growth in the platform, that they can get to a roughly 50 million GMV. So think that they take a roughly 20% cut, then that would imply they're getting, a little about 10 million, a little less than 10 million. So that's where Ben was saying, high single digit millions, right? That would be their break even on the platform with that 500K in monthly cost, the 6 million in fixed cost, and the, let's say if you're doing 50 million in GMV, that's where you're a couple million in processing and hosting for the credit card and for the domain, et cetera, is coming into play on the the variable cost side. So that's good to hear. It does also provide us as investors an idea of what will be a failure should they not get to that point. And unfortunately, we won't know if there will be any repercussions for the CEO, and we don't know why precisely the CFO left. At least I didn't hear a reason behind it. I'm just looking at my notes from the call. Obviously, he called out, and the 10K came out while the conversation was going on. So Ben noted it. They're up to just under 300 million in net operating losses. So they have a pretty huge tax shield for when and if they ever become profitable. The 346 million through 2031 of guaranteed licensing minimums, that is obviously a guaranteed minimum. And they would expect to have some overages on some of those. And of course, any incremental growth from there is great. So when they kind of asked him the sum of the parts, he threw those out there, for the first question in Q&A. They talked about kind of the pro forma calculation of, what EBITDA, would have looked like. They talked about the roughly 25 million and the 8 million in Centerfold related upfront costs in there. So, calling it 33-ish million in pro forma EBITDA is what they're saying, which also doesn't sound like included all of the cost takeout, which they've got. They claim they took an incremental 10 million out this week and will have another 5 million in cost takeout shortly thereafter. So, I mean, it's hard to believe anything that comes out of their mouths, to be quite honest. But again, that's what they're saying. So just trying to recap it. The business is trading down a little bit here in after hours. So $1.88. The fully diluted share count, I believe, is now around 74-ish, 75 million. So, we're talking about a market cap around 140. You have to add in the preferred stock with the net debt. Lance mentioned cash at 35 million as of today, and the 157 million in net debt. So that's roughly 122 plus, let's call the preferred 60 now, since they've got a take the 18% in annualized cost. So 140 plus 60 plus 122, we're talking again 325 million in an enterprise value at this point in time for the amalgamation of businesses. So it's a bad result. They're obviously trying to spin it as well as they can. There are some, I think, positives to see that the creator platform is showing some good trajectory without them incurring any marketing expense. But clearly the market doesn't really care because they're sick and tired of Ben Cohn's promises with the stock trading down in after hours. So I'll pause there. Arda, I know we've spoken in the past. I'm curious to hear your perspective. And again, anyone who's in the audience who wants to come up, Jiro brought you up as well. We'd love to hear what you guys are thinking about it. So Arda, your floor is yours, sir.
Hey, Rod. Hi, everyone. I'm exactly on the same page as you. I mean, there are a lot of nice things they've said, but who believes them anymore, The problem has been execution. And, 25 million plus the 8 million, 33 million of potential EBITDA with a 320-ish EV is like around 10 times EBITDA. So right now, I think the stock is fairly valued at this level. I did like a really fast analysis on their creator platform revenues. They claim to have 15 million as of now annualized, which is like 300,000 a month, week. If you basically compound that not by 9%, because magic of compounding gives you crazy numbers, but if you compound it just by 4%, you get to the 50 million, let's say, annual GMV this year, which is kind of the break even I think they're targeting. But what is interesting is if they do the 4% growth on a weekly basis, which gets them to around from 300,000 weekly to around 2 million weekly, basically in the 52nd week, which is a huge growth, as you can imagine, because of the compounding magic. And then if you take that 2 million and annualize it for next year with no growth, that's like 120 million of that platform's GMV for next year. So at that point, it becomes interesting. What's past is in the past. By looking at the numbers today and seeing, basically looking at their last 12-month EBITDA plus the 8 million, pro forma is 33, assuming the creator platform is neutral this year. But if you kind of get to a 100-ish million or 150 million on the creator platform side with a 20% margin, that gets you to like 20-30 million their cut, which is going to be basically 15 to 20 million in free cash flow for next year, which is kind of a big improvement. So that's the only good. That's one of the good news I heard. The second is like them basically realizing that they cannot manage this complexity anymore, which we knew, which you knew more than I did from the start. Basically, all the businesses have fallen apart, except they didn't manage to ruin the Honey Birdet brand by that much so
Not
far.
Yet.
Let's hope they don't do crazy things.
It
but
was nice to see the
getting
breakout of
out.
how much better the U.S. stores perform versus Australia. So, not that that's really
Yeah,
crediting them with much of anything, since they only opened a handful in their time of owning the enterprise.
yeah, I think also Australia is a mature market. I don't know how it will evolve in US. Let's see. I mean, it may be the first time people went in and bought a lot. Maybe they will slow down a little going forward. Who knows? I mean, we'll see about that. But I'm curious if they're going to get any money from Yandy. I mean, at this point, if they gave it out for free, I mean, that's what probably they're thinking. And lovers, I think they also should basically probably get rid of it soon, so that they simplify everything. And then, as they mentioned, they get a licensing fee from the Playboy pleasure line. I mean, there are one thing I wanted to hear, and I was kind of disappointed, is this JV in China. I was expecting some kind of a larger proportion partnership from the Chinese partner, and potentially like putting in some money, uh, which would further delever the company. But apparently, they're just giving them 15% for managing all the stuff in China. And they claim that they had a cost of 9 million in the past, and they'll have a similar cost with the JV partner, with a stronger partner, etc. I mean,
That 9 million was new information to me, because I'd always wondered where that cost was coming for their licensing business. So clearly, the licensing top line rev, you less out that 9 million in cost, in addition to whatever other costs they have. But that's the big item for why that licensing EBITDA was 70-75%.
Yeah, I wish they cut instead of 15-25 and gave us 20-25 million to further delever. But Chinese aren't stupid, so let's see what happens going forward. Overall, I mean, I'm also not happy with Lance leaving, because I mean, he was one of the guys who had, I mean, still you can see him talk reality, right? And Ben is flying, and Ben is just his usual self, you know. I mean, if you heard him for the first time, you would be impressed. I think that's what the market did 6-7 quarters ago. But now, I mean,
yeah,
he's
now it's
basically, he
show
doesn't have
me,
a.
don't tell me anything. You gotta show me. So, right, I think you're right. If they'd come out with this creator platform, these operating metrics and growth metrics last year, it would be a little bit different. I'm sure they had hoped by not sharing all the creator metrics in the PR and sharing it in the call that maybe they get a boost after hours, but it mostly seems to have stopped the bleeding rather than actually causing any sort of a rally.
Yeah, if you have this creative platform doing 250 million a year in 2-3 years, I mean, that's totally a different scenario. I mean, we could go back up to double digits, but they need to execute.
Yeah, I think what
It's
what
simple
was
as that.
interesting, I heard like one of the last things Ben said was basically that if their business plan doesn't materialize, they'll sell the business. So that's not word for word, but that's in line with I mentioned at the onset of this call and yesterday in our open mic that I'd had conversations with other investors who've had conversations with Rizvi, Suhail, and that aligns with what I heard that investor was told by Suhail. So, that's reassuring to me, just knowing that, listen, they've got one more shot, and if they don't execute, the reality is that gets back to the sum of the parts discussion where, what is Honey Birdette worth? Are they going to get 300 million like they paid for it? I don't think so. But should they get more than 150 million, 200 million? Probably. And that's where, it depends on how much incremental dilution we have to go through before we get to that end point. Ben made a comment that they don't intend to raise capital at these levels, something like that. So I would not put it past him, though, to do something shady if the stock were to rally at some point in the coming weeks or months to raise more capital, to pay down more debt. But who knows? At least at these levels, it sounds like they won't be diluting shareholders anymore. And it is great if that's true. Again, we'd have to trust that Rizvi will cause something, because the control is all his.
And one new thing, the artwork he talked about, I don't know what the value is.
Yeah, so I had
what is left
looked
there?
into old transcripts from the old Playboy, and let me pull it up and find it and pin it. I've done this liquidation analysis 6 or so months ago, but the artwork, they had in like the mid 2000s gotten a quote that it was worth more than 20 million. So that market has been hot. The question, though, and what I've heard between all of the discussions I've had and from observable reality, the fact that you didn't sell artwork and instead raised all of this capital at $2.55 per share tells me that you don't have the artwork ready to be sold, and you don't have it well categorized, cataloged. If you should have already sold the artwork rather than raising this extraordinarily dilutive capital at all-time lows. Let me find that and pin that.
What do you think now is the liquidation? If they were unsuccessful, let's say they were pretty close to free cash flow positive, they didn't ruin anything else. What do you think is the liquidation value?
Yeah, I just pinned it. So this is before they sold the jet.
Okay.
I did this like a week or two before they ended up selling the jet. Obviously, that's been sold. Yandy, I put at 5 million. If they sold Lovers for 10 to 15 and Yandy for nothing, it's fine. But you can see the range I have is between around 6 and 900. That's with me treating Honey Birdette at a range of 180 to 270, and the Playboy IP at basically on the low end what the current enterprise value is, which again, if you just strip away all the noise from all the gross costs that they have in this model, if you just look at a licensing business where you have a 60, let's call it 60 million in revenue, and you get away from this costly agent model, you're still running, I think it's like 40 odd million in operating income for the licensing business. And licensing is obviously high margin, should be high multiple. It's very low ongoing capex that they need to maintain the Rabbit Head IP. So I've heard in my conversations with other investors, whenever I've kind of talked about thinking at conservative liquidation at 600 million, everyone I've spoken to has been a little bit higher than that, even on like a low end conservative liquidation. So take that for what it's worth. But just thinking again, if the current enterprise value is 325, you're going to get at least 2 to 3 times your money on the stock from these levels if it went that direction. And as Arda, you noted, if that creator platform does grow, well, that is obviously worth something, and it could be worth a lot. But nobody believes them right now, understandably so. I don't know if you would push back on any of those values that I have in there.
Yeah, for the first time, they've given some numbers, so that's a good thing. But really, what's the worst thing about this call is Lance leaving.
Now, the worst thing about the call is Ben staying.
That's true.
But yeah, you're right. It's not good to see the CFO leaving.
I think, at 180, 188. I think there's not
Well,
that
look, I
much
mean, the
downside
reality is
left
there's not a solvency concern anytime imminently. They have
for
the
now.
cap for
Yeah.
now. Yeah, exactly. But that's where I come back to, they've proven quite poor managers of capital, but you have an asset that you could sell that would wipe the debt to zero, in my view. So, I don't want them to sell Honey Burdett at a fire sale price. I actually agree that there's a great opportunity stateside. I've been to both of the Florida store openings, and I was impressed by the turnout and kind of by how much they can pack into that little store. Right? He mentioned it's like 800 to 1,000 square foot, whatever. It's very, very small storefronts, and they get a lot of high margin goods in there. And the brand seems to be solid. It was last February that they opened the Miami store, and the entire Wook team was there. We had the opportunity to speak with the Honey Burdett CEO. We were impressed with her. The Tampa store opening was not too long ago, and it wasn't as well attended as Miami, but it was still, I think, solid for a weeknight launch in Tampa International Mall. So, the Honey Burdett asset is worth more than their net debt, in my view. And that's where I think if we get to the back half of the year and the creator platform is not on that trajectory that they articulated today, I would not be surprised to see, the entire, them probably sell Honey Burdett and shortly thereafter sell, the balance of the business and wind up shop, which I think would return at least $6 or $7 per share to shareholders. Although I'm again speculating, I don't know anything with certainty there.
Are you aware of the other big shareholders selling, or are they done selling? Or
yeah, so Right
what is
Builders
going
Union
on?
had filed the 13D about a month ago, and from my conversations with other investors, they are fully out of their position and they are dissolving their fund. So it was a forced liquidation, which obviously depressed the share price further. Which that's the best time to be a buyer in some cases, right? When there's a forced seller. But they are out. Rizvi owns just under 30%. Ben owns whatever his 4 or 5% is. Wook owns. We've been diluted, so a little less than Ben now. I know I've spoken to other shareholders who own a percent or two here and there. So, there's really just not that many shares unaccounted for, to be quite frank.
Let's see. I mean, it's I've got into the stock like you, probably like low teens. My average is probably now lower, but I've already written it off in my portfolio, to this level. I'm marking. I have it marked to market, and I'm not. I wouldn't be disappointed if they sold it for $2.50, $3.
I don't see that happening.
That's
frankly. Based on the conversations I've heard that those who spoke with Rizvi, I didn't hear this directly, and I'm piecing it together from multiple conversations, but the sense I have is that his view is in the liquidation if they end up liquidating everything, because the creator platform is, falls on its face, which I actually believe is the base case here. I don't think that those growth rates continue. I hope to be proven wrong. It would be good for Wook and for me personally. But his view being a liquidation, he wouldn't sell for less than $7, and that, on an executed, if they execute on the creator platform, a view that it could be worth, $35, which again, whatever, who cares what his view is? He does own a third of the company though, and presumably has some insight. Although the fact that he's allowed Ben to continue as CEO, I think, is just unacceptable for shareholders.
Yeah, I mean, maybe it's a good time to average down.
Yeah, every time I've thought
Who
that,
knows?
it just brought more pain to myself, Arda.
But who is the next seller? I mean, it's like the market has been going up and down recently, and this stock has been for the last, I don't know, 5-6 trading sessions hasn't gone down until now. It's been stuck around $2, which was kind of a
And I noticed
relief.
until the last 15 minutes of trading, today was the lowest dollar amount traded in the history of this company since DSPAC. So it broke over 1 million in the final half hour of trading, but it was going to be a little under 1 million. When I had glanced at it, it had 400 something, 450,000 volume. It's up, of course. There's been after hours volume, but it was very low volume with a sub $2 VWAP. So, yeah, no one really cares about it. I am curious. I mentioned these other conversations. I had heard that there were a lot of parties interested in hearing about how Centerfold is shaping up, and that they were sitting on their hands until hearing that. Clearly, no one is ebullient in after hours here, but yeah, it will be interesting to see how the stock reacts in the coming days. I don't know if anyone else, I saw some other folks I know who've been following it for a while, had heard anything in the call or seen anything in the 10K that maybe they skimmed through that they'd like to add. One thing that Lance had said that I didn't bring up was the IT implementation. They didn't complete it. We, Wook Capital, haven't spoken to management. We don't intend to speak with management ever again, frankly, until there is a change at the C level. But when we spoke with them last, the messaging was that if they didn't complete that IT implementation by peak holiday, they'd have to basically pick it back up around now, after Valentine's holiday wrapped. So I assume, and the fact that Lance is leaving is obviously not good news. My assumption would be they're close to completion on that, but the fact that they didn't say anything to that and Lance is leaving doesn't make me want to hold my breath. Jiro, go ahead.
Hello, Rod. Yeah, so I also took a couple of notes, yeah. So you guys already discussed the impairment, right? The 310 million, which is mainly, I guess, the goodwill of Honey Birdette, right? Then I noted down, yeah, because I'm also skimming through the 10K, right? And COVID is still this macro excuse. Yeah. So it's fascinating that they. No. I think they already have annual 10K. Or what do you mean by third quarter?
The impairment was last quarter. It's not new for this quarter.
I see. Yeah. Okay. Thanks for clarifying. Cool. Yeah. So how do you say? So while I was skimming the 10K, I noticed, macro excuse, China, of course. Although it also seems like to be the last straw, right? Because they also want to say it's a growing opportunity still. Then it was interesting at the very end that they highlighted that they were aggressively cutting costs, right? That's fine, but I still don't understand the growth story really, to be honest, right? Because we heard about the creator platform and about the NFTs, right? But to really grow again, right? I don't see a bigger vision, in my opinion. Okay, what else did I note it down? I noted down which will also be very interesting is the long-term loan, the 160 million, because in 2021 they paid interest of 6.2%, and end of 22, 11%. So
and they noted
almost a doubling, right?
Was the expected interest cost for this year, which I don't know how much of that is like them paying some down early and amortization type stuff.
Yeah, exactly. That's what I was going to ask. Like they said, debt service is 18 million, so there may be some small.
No, 18 million. But that makes sense. The 18 million actually, because 11% of 160 are 17.6 million. So that adds up.
Yeah, maybe they don't prepay anymore.
Right. I don't think they prepay anymore until again, this is my sentiment from both this call and from those conversations, that it seems clear there is finally a look. If this does not succeed, we're just going to sell everything off. If we don't get to where we want to be by year end, and they have a timer in effect, because the timer is the return of the covenants. Return of the Covenants, Return of the Jedi, whatever you want to call it, coming, in 2Q24. So that's why I think that the business is on a timer. If to your point, Jiro, about where's the growth, if the creator platform grows and scales, that does begin to generate meaningful free cash flow. As Arda was noting, all of that, once you get past that break-even point, is just incremental free cash flow, which for them would then be invested in the higher return Honey Burdette store openings. Clearly, they're going and backing away and doing a 180 from the direct consumer use of the Playboy business, but still, increasing, I guess, sales of all Playboy branded things. They have a lot of markets that they're just underpenetrated in. But regardless, that's all long-term shit. The reality is, in the next 9 months, it will be, if the creator platform cannot achieve the growth and the velocity necessary to begin to be a source of cash, I think that they part and parcel everything out.
Yeah, but but maybe I can ask you, Rod, or you, Arda, because the creator platform, right? I mean, why do you need a creator platform when you also have Instagram and that kind of stuff? Or who are these creators actually?
Yeah, I don't know if you saw. So look, this is basically, they're basically trying to sell a clean version of OnlyFans, and
Okay.
that's kind of, they're trying to do a suitable for work sort of OnlyFans, which they have the 1 or 2 creators that have had a lot of success. Ben obviously touting, creators love the brand, yada yada, whatever. That I could appreciate the thought that a creator would prefer to align themselves with their Playboy brand than with Fansly OnlyFans. But again, what is the real cost to the creator from just putting the same content out on all of them? I don't think that they have. I'm not very bullish on it, frankly. I've been calling for them to shut it down basically since the botched acquisition for $30 million in equity of Dream. So it's been more than a year that I've been calling for them to shut it down, frankly.
Now that's the only thing Ben is holding on to,
Exactly.
That's his. If he's successful, he keeps.
If it's
running the
successful, he
business.
keeps
If
his
not,
job, and if it's not,
yeah,
everything gets sold off. That's how I see this playing out, based on
yeah.
what he said today and what I've heard from those who spoke with Rizvi. Yeah.
Yeah, I mean, they should, going forward, I mean, they should be, I think, more transparent. I mean, they should get someone to properly share information on slides, I mean, instead of putting those pictures on that presentation, I mean, they should basically have some numbers, proper numbers, I mean, it's really crazy how they.
You mean slide 17, which is just quotes from creators, doesn't do it for you?
I mean, it's crazy. I mean, how many beautiful women are on that presentation? I mean, who cares at this point as shareholders, right?
Show me the money, as
Yeah, exactly. I mean,
as a famous
they.
character in a famous movie once said.
Do you know what's interesting? I'm a value guy. I mean, the only other things I hold besides Playboy is coal stocks, metallurgical coal stocks. And when I bought Playboy, I was like, oh, this is my only growth story, Now, interesting enough, it's become a value play. It's trading below liquidation.
Yeah, again,
right?
as I said, I have not had anyone who's done a lot of work on this come and say that they think that a liquidation yields less than 600 million. Most are above or at 700 million of those discussions. So, if the EV is 325, yeah, I mean, this is just an ugly duckling value sort of play that I have to hold my nose. I've actually been holding my nose during this whole discussion.
One thing that was interesting was Hedgeye note, They have these three ugly ducklings, which is Playboy. He admits that this was the worst call of his life. The other one is All Birds. And the third one is Real. And he ranked them in his last piece. And he basically has Playboy in the third place. He has All Birds 1, Real, I think, second, and now Playboy in the third place of the skeleton stocks. So, but I've been looking at the others, the others don't have the IP that Playboy has. They don't have liquidation value. They're losing a lot of money. At least we hope that there's a liquidation value in Playboy.
Well, look, I mean, there's a licensing business, and I guess that's where the concern comes around. What does the actual shape of this China JV look like? And he mentioned they've got, at least with the agent, the contract through 2028. So I know that with the licensees in China, a lot of those contracts also run out several years. So I don't know. And I'm looking at my notes. I didn't get a satisfactory answer from Ben when the question was very precise. What's the financial impact of the China licensing shifting to JP? All Ben said was, I don't see any financial impact. And then some other, mouth noises that didn't really make much sense to me. So I didn't write them down. I don't know if anyone heard any useful detail. It's still very much unclear to me what it actually means financially, if anything. But like a licensing business like this, and I know there aren't that many like I guess comparables. Is just a problem here. It's such a convoluted business with so many different components of it. Artie, you made the point. Right now, it's around a pro forma 10x EV to EBITDA. Well, I think licensing actually should be much higher than that. Licensing should be, maybe 15 to 20x. Honey Birdette maybe is closer to the 10. And then sure, Lovers, which is a very small component of it, will be 4 or 5. But like when I would think to weight it out, I actually think that it would be higher than 10, given the components. But that's where, again, the company's done a horrible job, I think, of clearly articulating which what segment is driving what. And even with the first question of what is how do you size up the different pieces of the business, Ben mentions the art collection but fails to make any comment about evaluation. Ben, you can't just say that we have an art collection and then not say actually we've had it appraised at 25, 30, whatever. It's just at this point unacceptable and disappointing.
Yeah, one thing that was, I'm rethinking now, they're doing all these restructurings, making the business simple. It's also a way to sell them, right? If they were to liquidate, they have this China JV. They can bring a buyer for the remaining 85% of that business, potentially, right? They have Honey Birdette, and they have this creator platform. And they don't have much else. Yandees and Lovers, I'm assuming they're gone. And they have the Playboy.com, which they said they'll potentially give it to also a JV partner who will run it. So there are basically several, like 3 businesses: Honey Birdette, JV in China, JV US. It's the JV licensing business, plus this drinks, etc. And the third business is this digital. And I was also surprised to hear that, not surprised, I should have probably read the 10K better, but this TV business is still generating some cash flow, which they may potentially also, sell. Or to raise money, because Ben was saying, "Oh, we don't need to raise any more equity at these crazy levels. We have other places we can raise funding." I mean, what are those areas? And is it like the artwork? I was thinking, which came to mind, but it feels like they're simplifying and potentially getting the business to be sold in parts if this thing doesn't work. I mean, they're also getting it ready for that, I think. Because Yandy and Lover, Lovers, and how much margin could they have brought? I mean, those businesses I thought they bought in the beginning to learn the online business, and that was it. And potentially for Lovers, put their merchandise into those stores. But more to learn the business than, because they didn't have anything, right? I mean, they had the magazine and the licensing business when they did the spec, and they bought these two businesses to basically start learning about online and some like mall business, right? So I mean,
Yeah.
it's
So let me just add, I mentioned that I found the artwork estimate from an old earnings call. I'm looking at it. It's May 2007, to kind of remind folks that the old entity has been around for a while. It's the 70th year of the brand. But the quote is that in the past, people have estimated the art collection to be in the $20 million range. Again, this is going on almost 20 years now. And I know since then there have been some sales of the art, and there's of course been inflation in the value of artwork broadly. So that's why I put the 20 to 40 in my own liquidation estimate. I don't know, what they could really garner, but that quote, that includes now things like our cartoons and other artwork that was created not by artists necessarily, but by our own people, photographs, et cetera, et cetera. So that's the best I have to go off of. And then I made the comment earlier that I'm not so sure they have a good grasp on precisely how much artwork they have and where, which I think is evidenced by the fact they haven't been selling artwork, and instead, did the large rights offering, and Ben not providing a number today.
Yep. Let's see. I mean, how the stock reacts tomorrow.
Yep. So, the stock is now, I see the last trade at $1.90. So still down from the close, but not as low as it traded upon the release. Let's see if the folks who are apparently on the sidelines and wanted to see the result were happy with what they heard about the creator platform. I'm going to wrap this up in about 10 minutes, though. If anyone else, wanted to come up and share any thoughts, if there's anything we missed from the discussion, just only so much to say. I mean, just to
There
say
was
one
a
thing, Giro, like you mentioned, where is the growth? Again, the opportunity, I do see a real opportunity for the luxury lingerie brand. They see 100-store opportunity for Honey Birdette in the U.S. They're at 10 stores today. I mean, even when they bought it, they talked about an opportunity of north of $500 million in revenue from the U.S. If those stores are generating, look, it gets back to, can they invest in that? Can they generate some cash and keep this thing together? But it gets back to, when I think about the downside risk and the margin of safety, going back to Arda's point about, this is really not, yeah, there's sort of a growth play here, but I'm looking at it more from a, if we know the CEO is on a timer and we know that these assets do have value, and I was made aware that Jefferies thinks they can still fetch close to the 300 million for Honey Burdette. I mean, Jefferies is going to talk up the number, but again, if you could literally wipe the debt out with a sale of Honey Burdette in a worst case scenario, you really don't have solvency. Although then you are at the whim of what Ben Cohn does with your capital, and that's the bigger risk, frankly.
But I guess the interesting thing is, to look at the bigger picture, right? I mean, Playboy was such a big, huge brand, right? I mean, back in the days with the magazines and that kind of stuff, and they mentioned that they want to come back with a digital version or something. I think it's also a little bit an identity crisis, right? Okay, so they bought now Honey Burdette, but they also need to figure out like a real growth, a real growth revenue stream, right? And so I'm not sure with the creator platform if they also mean like to get like very big influencers, let's say from Instagram, and get them over to their platform if they can afford it, or if they can make it attractive enough, or if they are not doing that anyway already, right? Because I'm actually not aware if they really get the big tickets anymore, right? Because back in the days, like all the actresses, they wanted to be on the cover, right? So I don't know if it's the same nowadays. I guess not, right? So if they can, So maybe that's a growth opportunity to get the influencer ladies.
Yeah, that's what they've talked about. The thought was that when management decided to put that at the front and center of their strategy, that would serve as a flywheel for their entire ecosystem. And clearly no one's really buying into that. One other thing that we didn't talk about, you mentioned NFT Giro, and obviously the company hasn't talked much about it, but they do, it's again, a curiosity, right? For any company that holds digital asset like Ethereum or Bitcoin on their balance sheet, they have to mark to worst. So any period in which the asset trades below, because it's an indefinite lived intangible asset. So when it goes up in value, you don't get to mark it up. You only could realize a gain from your marked down value when you sell. But they do still have. They basically took almost $5 million in impairment charge against the Ethereum they did hold in 2022, and the carrying value is down to 0.3. So I do think, though, if they turned around and sold that Ethereum, they'd probably get a couple million out of it, which, again, it's not going to move the needle, but more curiosity than anything.
Another thing that was interesting, I think, that they mentioned was the creators. They were making like 12,000 annually, and somebody was making like $1 million. I mean, I don't know who that, like, annualized.
Amanda Cerny is the one creator who's really done it well on the platform, and I think anytime they share a good data point, it's using her as the proxy. Because you're right, there's a huge dispersion between her at $1 million GMV and the average at 12,000.
Yeah, because 12,000 is pretty low.
Yeah, and I know that their new, I don't know what Lauren's formal title is, but she's kind of been running the college circuit, trying to get young ladies onto the platform, I guess. So, look, they mentioned having 10,000 or so queued up, but they just have to get onto the platform. I don't know what the problem is for them to allow people to join at scale yet. But yeah, that, and at the end of the day, that is what they've put front and center, and that is what we will have to hear more about in Q1 and Q2 on how well this wonky CAGR that Ben has thrown out is progressing. Mr. DCC, excuse me. I know you've been following this for a while. Would love to hear your thoughts if you're able to come up. It's showing me spinning connecting. I know that Android devices were having trouble yesterday, so I don't know if this is a recurrence of that.
Until he comes on, how is the platform? I haven't been on it like for a very, very long time.
I played around with it on my mobile device earlier this week on the back of he commented, right, that they've made some improvements. I mean, I don't use these personally. The web platform, if you access it from a laptop, is still not native. It's a mobile native, and it doesn't look it's not usable on desktop, but on mobile it looks fine. I guess it's still a work in progress, though. It's definitely not. I don't know. I haven't used OnlyFans personally, so I couldn't speak to that.
Is there there is no application, right?
Correct. There's no app store cut that they've opted
Yeah, because
to
they
not
don't
use
want to
that.
pay.
Yeah.
But can I ask, Rod, can the creators then also communicate with their fans?
Oh yeah, that's
on
how
this
they make
platform?
money, right?
Yeah.
It's
Yeah.
it's not just them selling the pictures or the subscription. It's, pay by the message communication is a big portion. Obviously, they haven't opted to break out the mix. I, off the top of my head, don't remember what I had read about OnlyFans mix breakout, but the messaging is a huge component of it. Yes. And what I've heard from people who actually have built these businesses is that it's often not the creator who's communicating. It's, some outsourced labor in Southeast Asia, to be polite.
Makes sense.
You're not really talking to Amanda Cerny, maybe, when you think you are. Let me not use a specific person's name. That's not fair to her. I have no idea. I just know that broadly speaking, that is how the industry works.
Rod, we're different than the industry. I bet the creators are messaging themselves. Let's put a selling point on the creator platform.
DCC. So I don't know if it's just this. If you're using an Android phone, that's probably the culprit. Because yesterday we were trying to have people join, and I then joined another space later and heard that this has been ongoing, where like Elon only likes iPhones apparently, so Android users are screwed. Sorry. But DM me your question or your comment if you want me to say it. If you can't get up here. Yep, you're on Android. That's it.
There was one large seller after hours, and somebody took it off. Like somebody was trying to sell 50,000 shares earlier, right after earnings.
There was a big sale
190, 180,
yesterday, right? It was like a $500,000 share, something big.
Yeah, I wasn't looking because it wasn't moving. So, was it a block sale?
I saw someone comment on it in a Discord. I can't say that I followed it closely. But I guess the way I would wrap it up is that the operating results were pretty disappointing. Looking forward, though, the balance sheet is fine for now. They're going to focus on this creator platform, which they shared some promising tidbits about. We'll see how it progresses throughout the year. And they did note that if their business plan doesn't materialize, they'll effectively look to sell things off. They're, of course, undergoing the strategic review pertaining to both cost cutting and disposal of other non-core assets. They mentioned they expect Yandy sold shortly, and Lovers, I think, will likely be sold as well. So trying to clean things up a bit from their self-imposed messes that Ben Cohn got them into, who has been the CEO for 7 years now. Let's not forget, whenever he kind of talks about these things that will be done and could be done, I'm very reluctant to give him any benefit of the doubt, given he's been the CEO for a majority of the last decade. And I tend to think that he's the one who needs to fall on the sword. And regrettably, we heard him being, again, very, with his commentary about him bringing incremental capital in and asserting that the significant tax-related sales were not discretionary sales, et cetera, et cetera. Yeah. So Mr. DCC said to me, quote, "This company intentionally makes itself hard to understand. The annualized numbers are good to stretch out and distort." And I think that's a very valid point. Clearly, the market, as Arda and I were kind of saying earlier, the market is no longer believing these numbers, these annualized, pro forma, adjusted, whatevers. And the proof will need to be in the pudding, and they need to put up or shut up. So it's 7:01 Eastern. We've been open on this for now over 2 hours. I think we've exhausted the discussion. So thanks everybody for tuning in to this presentation of Playboy's fourth quarter earnings call and discussion. We will look forward to being back several weeks from now to talk about 1Q earnings. Just some programming notes. We'll be back tomorrow at the close of business for our weekly Wookin review. Hope to catch some of you there. We have a lot to talk about, and Jiro would like you to be there. We're going to talk about rates and the banking system a little bit,
Amazing.
and the craziness that's happened in the last week or so, as
Nice.
well as we'll obviously talk a little bit about the Playboy earnings call there, and we'll talk a little bit about AMC's resolution for now of its of its curious preferred structure. So we'll have that coming, and then just from our book club perspective, for those of you listening who are unaware, we host a monthly book club. We will be covering Greenblatt's The Little Book That Still Beats the Market on March, the last Tuesday in March at 8 o'clock Eastern. So that is coming up in 2 weeks' time, March 28th. And I know that Joe was in here earlier, and it's my birthday next Tuesday, and GameStop has earnings next Tuesday. So I'm going to be enjoying my birthday and not listening to the earnings call, but I know that Joe or JP or some other members of my team will be hosting for GameStop earnings, since we know a lot of our followers are interested still in what's going on with them for their fourth quarter results. So that's what we've got on the docket. Again, thanks everybody for tuning into this discussion around PLBY's earnings call. And we'll stay safe out there. We'll talk soon. Cheers, everyone.
See you. Bye-bye.